What is an offset mortgage? Most people have never heard of one, but for business owners juggling payroll, invoices and tax deadlines, it might just be the smartest financial strategy that you're not using. Imagine taking that spare cash in your business and using it to pay off your mortgage faster, tax-free, almost. So let's dive into offset mortgages, one of the best kept secrets for business owners looking to save thousands in mortgage interest each year. Offset mortgages link your mortgage with your savings, but probably not in the way that you'd expect. In this video, I'll explain exactly how they work, who they're ideal for, and share you several practical examples that show their true potential. Please don't rush off and set up an offset mortgage without watching the whole of this video. There are some potential tax and compliance traps that must be avoided when doing this. We'll be covering each of these and what to do about them, but we're going to cover the basics first. So, what is an offset mortgage? Simply put, an offset mortgage is a special type of mortgage that links your mortgage to a specific savings account. And rather than earning interest on your savings actually reduce the interest payable on your mortgage. The savings rate will be exactly the same as your mortgage rate, and so, in effect, the savings gained offset the interest charged. Depending on your provider, you should then have the option to either reduce your monthly mortgage repayments by the interest saved, or let the interest accumulate and count as a slightly early overrepayment. Personally, I would recommend the overrepayment, since then you get to benefit from compound interest. Now, you're probably screaming at the screen, but Joe, I can get a better savings rate than my current mortgage rate. Wouldn't I be better putting my money into a savings account rather than this offset thingy? Yes, potentially. But the main benefit with the offset account is due to the way that they're structured, and that's that the interest gained in an offset savings account is actually tax-free. Let's say your savings account gives you 6% interest per year, and we know at the moment, June 2025, that's actually quite a high interest rate, and you're probably not going to get that. Let's say that your offset account is 4.5%. 4.5% is probably the rate you'd get at the moment with an offset account. 6 versus 4.5 seems like a no-brainer, right? Yes, but remember, if you're a higher rate taxpayer, you'll pay 40% tax on that savings interest. This means that your actual return on the 6% savings account after tax is only 3.6%. Compare that to an offset mortgage, where your effective rate of return is tax-free and 4.5%, you can actually see that you're better off by nearly 0.9% or a whole percent in a year just by using the offset mortgage. And that's before we even talk about the compounding benefits of reducing your mortgage faster. Plus, on a side note, even if you do find a savings account offering a slightly higher rate than your mortgage, it's worth noting that that return isn't always guaranteed, especially over sustained periods. Interest rates change, introductory rates expire, and bank terms can shift. With an offset mortgage, your return is effectively fixed alongside your mortgage rate, giving you more certainty and predictability over time. I appreciate that this is a lot to throw at you, but please don't worry, stay to the end and we'll make sure that you understand everything. So let's make this real. Imagine you're a limited company director who typically has around £70,000 of business cash sitting in your account as a sort of buffer each month. And by this, I mean the surplus cash that you keep in your business to cover things like payroll, VAT, or just keep it there for unexpected expenses. If you're a business owner, then I'm sure you're aware, but most business bank accounts pay very little to no interest at all. That cash is effectively just sitting there doing absolutely nothing for you or your business. With an offset mortgage, you could withdraw that £70,000 from the company as a director's loan, place it into your personal offset savings account, and then return it to the business later when it's needed. I'd like to emphasize you're not spending the money, you're just moving it temporarily. Let's say you link that £70,000 to your offset mortgage at 4.5%. The annual interest saved will be £3,150. The monthly saving will be about £260. Now you might think £260 or so, it's not huge, but remember it's tax-free and you still have full access to that money. In real world terms, if you had a £300,000 mortgage at 4.5% on a 25-year term, your monthly repayments to the bank would be approximately £1,700. If you had an offset mortgage and kept that £260 saving going each month, then you'd actually end up paying your mortgage off 5.5 years early. That's 66 fewer payments and almost £50,000 in interest that will be shaved from the lifetime of the mortgage. Now, if you've got keen ears, you'll have noticed that at the beginning of this video, I said that this was almost tax-free. Don't worry, we'll be getting onto that in a moment. Quick side note though, if you're interested in discussing offset mortgages, or any form of mortgage for that matter, I'm going to pin a link to the comments of this video. That link will take you to a very short form. If you input your details into that, and I'll introduce you to my mortgage advisor and business partner, Elliot. He'll be able to arrange a free consultation with you to discuss. Don't worry, you won't get any spam or be included on any other mailing lists. We'll just get in touch about this. Back to offset mortgages. Let's talk about that director's loan for a moment, because it's a really important piece of the puzzle. If you're a limited company director, there are typically 3 ways to take money out of the business: salary, dividend, and director's loan. For the purpose of the rest of this video, we'll be talking about withdrawing or juggling the business funds as director's loans. So we're not talking about dividends or salary repayment, we're talking about director's loans. Here's how it works. The company lends you money temporarily. You place that money into your offset account and reduce your mortgage interest. When the business needs the cash, say for VAT, payroll, or suppliers, you transfer it back to the company account and pay your company bills. Rinse and repeat. Simple, right? Well, almost, but again, we'll get onto that towards the end. Smart business owners are using this strategy to do things monthly, constantly moving funds between their company and their offset account to maximize every bit of value. However, here's the part I flagged at the very beginning of this video. There are 2 potential issues that a director or business owner might have here. The first is known as benefits in kind, and the second is known as Section 455, S455 for short. Don't worry about the technical terms, I'll break down each of them now. Let's start off with benefits in kind. If a director borrows more than £10,000 from their company at any point in the year without paying interest, or paying less interest than HMRC's agreed rate of interest, then HMRC treat this as a taxable benefit, also known as a benefit in kind, or sometimes it's written BIK. Benefits in kind typically incur employers' national insurance, which is currently 15%, and this is an additional cost for the company. On top of this, the employee or the director who's receiving the benefit will then incur income tax on the value of the benefit to them. The tax they need to pay will be at their effective rate of tax, so 20%, 40% or 45% depending on the rest of their income. From the 6th of April 2025, HMRC's official interest rate for these purposes is 3.75%. This means that if you don't pay interest on the director's loan that you borrow from your company, there will be a small amount of income tax payable by the person receiving the benefit and a small amount of employer's national insurance that's charged to the company providing the benefit. It's also worth noting that the employer's national insurance is actually tax deductible for the company, so will actually reduce your corporation tax bill slightly depending on your corp tax rate. Now I appreciate I've just thrown a lot of information at you there, so let's break this down again and look at it with our previous example. Let's say you receive an interest-free loan from your company for £70,000. For simplicity, we'll say that you received it across the entire year. Then £70,000 times 3.75% means that you will have received a deemed benefit of £2,625. This is what will be subject to the benefit in kind rules. This means the company will incur an employer's national insurance charge of £393. And as a reminder, this is tax deductible for the company, so the effective cost will be closer to £300 to the business, depending on its corporation tax rate. And then you, or the recipient, if it's another employee or director, will incur tax on £2,625 at your or their marginal rate. So if you're a 40% taxpayer or a higher rate taxpayer, 40% times 2,625 means that you'll incur £1,050 of income tax for the benefit of receiving that interest-free loan. As a reminder, if your offset savings rate was 4.5%, then 4.5% times 70,000 means you've reduced your mortgage interest charges by £3,150, and those will all be compounding away at your mortgage principal, reducing what you owe over the lifetime even more. To me, even though there's a small amount of tax to pay, this is excellent value for a business owner. Now, don't go there, because if you'll remember, there's actually 2 considerations that you need to have. The first was benefit in kind, and the other was Section 455. Before I talk about that, I want to point out that this can sound a bit technical or daunting. I appreciate I'm going to be throwing some dates and numbers at you, but honestly, please do bear with me. It will make sense by the end. So what is Section 455? Section 455 is a tax or a charge that applies when a company lends money to its directors or shareholders, and most importantly, that the loan isn't repaid within a certain time frame. That time frame is 9 months and 1 day after the financial year end. This rule's there essentially to stop people from using their company like a personal piggy bank indefinitely without paying tax, which, to be honest, is sort of what we're discussing here, and it's why it's so important that you take it into consideration. Anyway, what does that mean in practical terms? Essentially, Section 455 is triggered if a director's loan is outstanding 9 months and 1 day after the end of the company's accounting period. So for example, if your company year end is the 31st of March 2025, a director's loan must be repaid by the 1st of January 2026. If not, Section 455 tax is due. Section 455 tax rate is 33.75%, which deliberately is the rate that a higher rate taxpayer pays on dividends. Again, that's quite high, so it's really important that you're not subject to it. This means that if you owe your company the £70,000 in this case, past the deadline, then the company must pay £23,625 in Section 455 tax to HMRC. This blows the benefit from the offset savings account completely out of the water, and this is why you need to put controls in place to avoid it. Don't worry, we cover them on this video. I'd just like to point out that although I'm describing this as a tax, it's actually a temporary charge. So if you did somehow fall foul of Section 455, don't panic. Once you do repay your loan to the company, the tax charge is then refunded to you. Although HMRC won't know it's been repaid until after your company's next tax return, which is why it's so important to make sure the balance is repaid before the company's financial year end. So this brings us on to the next bit. What do you need to do to avoid triggering this Section 455 charge? You might be thinking, well, Joe, it's simple. Just repay the loan before the end of the financial year. After that, take the loan back out again on the very next day. And if you're thinking that, you're on the right track, almost, but HMRC aren't silly, they've thought of that. So there is one more thing, and sorry, again, I appreciate I'm throwing loads at you. So HMRC are aware of this, and repaying a loan one day and retaking it out again the very next day is known as bed and breakfasting, and they've put rules in to stop this. Now, bed and breakfasting probably sounds like a funny term, and it all stems from the fact that until these rules were introduced, it's actually what a lot of people did years ago when selling their shares. They would sell them on the very last day of the tax year to crystallise a gain or loss. Usually, the gain would be tax-free, and then they would immediately buy the shares the very next day at the same or very similar price, effectively keeping their position the same while creating a tax advantage. The term came from the fact that you were effectively tucking your shares up for bed at night and then picking them up for breakfast again in the morning. As you can imagine, HMRC really didn't like bed and breakfasting, so they introduced what's known as the 30-day rule to stop this. What does the 30-day rule mean? Well, this rule means that if you repay your loan or sell a share and then take that loan back out again or repurchase a share within 30 days of the original transaction, then doesn't actually count as if the loan has ever been repaid or that the share sale ever actually took place. So this means that in order to avoid the Section 455 charge, you need to not only ensure that you've repaid the funds before the company's financial year end, but you also need to make sure that you withdraw the loan 30 days after you've repaid it. My advice here would be to repay all of the funds 1 month before the financial year end and then take that loan out again at least 1 day after the business starts its new financial period. Now, I appreciate that was a lot, so let's have a little recap. With an offset mortgage, you can withdraw funds from the company as an interest-free loan. Due to the benefit in kind that this creates, you will incur a small amount of income tax based on your marginal rate, and your company will incur some tax-deductible employer's national insurance. Throughout the year, you'll then be reducing your personal mortgage balance by receiving tax-free interest against your mortgage. To avoid the Section 455 charge, you'll need to repay any money you've borrowed from the company before your business's financial year end, and you shouldn't retake the loan out again for at least 30 days. So while this is a brilliant strategy, in my opinion, it does really need to be structured carefully. As always, speak to your accountant or tax advisor before setting this up. Ultimately, offset mortgages won't be for everyone, but for business owners with spare cash in the bank, they can be one of the smartest and most tax efficient ways to save thousands. If you're curious whether it could work for you, I'm going to pin a link below. If you'd like to be introduced to my broker and business partner Elliot, please complete the form and he'll get in touch with you. Have you thought about using an offset savings account? If you have and you've got any questions about it, I'd be genuinely interested to help. Please leave a comment below. I hope you enjoyed the video. I'll be doing a lot more content like this, so if you found it interesting and you haven't already, please subscribe so that you don't miss out. Thanks again for watching. I'll see you in the next video.